Welcome everybody to a virtual seminar presented by Dala Wealth Management at National Bank Financial featuring Ellement Consulting Group. My name is Sienna Foynacy and I'm an associate with Dala Wealth Management. At Dala Wealth Management, we strive to inspire, create, and develop positive change by optimizing your wealth and investment and portfolio management strategies that are tax efficient and built with you in mind. Our agenda today will respect your time as we aim to keep this presentation short and to the point to maximize its value. I would like to introduce the head of Dala Wealth Management, Romel Dalla. Romel is a portfolio manager with 15 years of experience who combines his investment expertise with the team's in-depth financial and estate planning. Romel will now introduce the principles of Ellement, who will then discuss opportunities, market outlook, and answer a few questions. I'd like to hand it over to Romel to tell you more about Ellement Consulting Group.
Thanks, Sienna, and once again, thanks for listening in on our virtual seminar. I'd like to thank Scott and Lucas from Ellement Consulting Group for joining us today. Individual pension plans are an important part of your overall financial plan, and especially if you own a corporation, they provide some benefit over traditional RSPs. And so I'm really grateful for having a pair of experts with us today to talk about them in detail. I'd like to introduce both of our guests formally. Scott Ellement brings 18 years of experience to his work in our pension and benefit community. His responsibilities include overseeing a number of our institutional defined contribution pension plans, individual defined benefit pension plans, IPPs, for business owners and executives, as well as providing expertise to our benefits practice. Scott also manages the operations at Ellement, including human resources and accounting. Scott has a Bachelor of Commerce Honors International Studies degree from the University of Manitoba. He's a certified financial planner, chartered life underwriter, and certified health insurance specialist. Lucas is an actuarial analyst from Ellement Consulting Group as well. Lucas brings 5 years of experience specializing in technical analysis, actuarial projection valuations, and plan design review, and also provides strategic retirement solutions for his clients. He's a graduate of the University of Manitoba with a Bachelor of Commerce Honors degree, where he majored in actuarial mathematics. Lucas is a fellow of the Canadian Institute of Actuaries and a fellow of the Society of Actuaries. I'd like to ask Scott and Lucas to begin their presentation.
Okay, thank you, Romel. I'm just going to share my screen here. Okay, like Romel said, we've been in the pension and benefit industry for over 2 decades as a company founded in 1998, and we've been doing hundreds of IPPs since 2004. So,
Scott, if I could just interject, I think you should put the presentation on full view if you can.
Oh, okay. Yeah, how do I do that?
There you go.
Good. All right.
Perfect.
Okay.
Thank you.
So we'll talk about what an IPP is. Everybody's heard of the term IPP, but there's some marketing things around IPP, so we'll explain that. What the target market for an IPP is, a few of the advantages and the disadvantages of why you should or should not have an IPP. We'll go through a few examples of what the numbers could look like at different ages, and we'll end by, well, what are the exit strategies? So once you do have an IPP and how you get your money out. So this presentation is very high level. Of course, for any detailed information, consult your financial and legal advisors. And of course, we're here to help with providing some additional information beyond the presentation itself. So what is an IPP? An individual pension plan is a special type of defined benefit pension plan. So when we say IPP, we're usually talking about business owners, executives, key personnel for corporations. We are not talking about group defined benefit pension plans. So I don't want to scare anybody away who's a business owner. Okay, what's defined benefit, run for the hills. We're talking about just the business owners or the key executives of the company. It is a registered pension plan, and really it's the Cadillac of pension plans in the country. When I say IPP, individual pension plan, it really can include more than one person. So if you're a business owner, you have a spouse For children that have T4 employment income in the corporation, they can all be part of the same IPP or pension plan. IPP has been kind of marketed around the land, just a term that was coined a long time ago, but it can include more than one person. Very important to remember that. So if you have a lot of, we have a lot of clients that have a husband and wife and children in the business. Very, very good, very opportune time to consider an IPP, and for them it makes financial planning just an excellent tool. Okay, what is the target market? First and foremost, must be an incorporated company. We can't have sole proprietorships participate for an IPP. The individual should generally be the ages between 40 and 70. You can have an IPP younger than 40. So if you have a 20-year-old child, they can participate, and we do have that as part of our client mix. But basically, between the ages of 40 and 70 are the sweet spot where the in-year contribution is greater than an RRSP contribution, and we'll get into more of those details later on. And the individual should have T4 employment income greater than $160,000. You can have it less than that, but ideally to get the maximum punch, we want 160,000 or more. And when I say T4 employment income, I'm really referring to box 14 of your T4 slip. So hopefully everybody's familiar with a T4 slip. And the third really requirement is, does the company have cash flow? So if the company has lots of cash, what do I do with it? Yes, I can invest in new technology or new machinery, or I can make another contribution to perhaps a individual pension plan. If you don't have sufficient cash flow, the IPP would not be right for you at this time. So if you're an incorporated company, you're generally in the ages between 40 and 70, 160,000 of T4 employment income, and you have sufficient cash flow in your corporation, you definitely should inquire at least about whether an IPP makes sense for you. And our block of business, we generally see mostly number one, like small business owners, although we do have a fair bit of incorporated lawyers and doctors and dentists as part of our kind of IPP portfolio. Like an RRSP, the investment choice within the IPP rests with the plan member and their advisor, so that all the investment selection still kind of the same RRSP or IPP, same type of deal. Similar to the RRSP as well, the investments in an IPP grow on a tax-deferred basis. Same thing as an RRSP. Benefits out of an IPP are tax upon receipt. Again, same as an RRSP, you get a tax deduction going in, and then when you want to withdraw the money down the road for retirement, that is taxed at that time. The IPP is greater in terms of contribution room than an RRSP. I think it's about 28,000, 29,000 for RRSP right now. And when we say the ages earlier in the slide about age 40 to 70, age 40 is when the contribution room for an IPP is greater than the in-year RRSP contribution. Not to say you can't have it, but just that's where it starts to make a better difference in the IPP. So we generally like to say an IPP is an RRSP on steroids. So that's why you see it there, and it really is true. And one important distinction for to note between an RRSP and an IPP, in RRSP, you make a personal deduction, and you get that deduction on your T1 personal tax return at the end of the year. With an IPP, it's the corporation that's actually making the contribution into the pension trust fund. So it's the T2 corporate tax return that would get the deduction. Just important distinction. That's why if you're a business owner, you're the employer and the employee, one and the same, makes no difference to you. And final point here, unlike an RRSP, we all went through the 2008-2009 Great Recession, and more recently with the pandemic in March 2020. If you, like many of us, had RRSPs or non-registered accounts, market values would have gone down. We just kind of cried and, well, what can we do about it? We can maybe rejuggle our portfolio, but we could not do any new contribution room, especially with registered accounts. However, if you had an IPP, especially in 2008, 2009, many of our clients we all suffered through the dip, same investment genius in the RRSP and the IPP. For those that had an IPP and had cash flow in their corporations, we were able to provide them with a funding opportunity to fund that dip in the market. Deficit would have risen because of the market dip, and those members that wanted to contribute had the opportunity, not the obligation, but the opportunity to actually put more money in to make up for that dip. So roles for the IPP. Normally you would have your advisor and custodian. So the new player on the block really is the actuary. So the advisor would do pretty much what he's doing right now for you, managing all your investment portfolio, providing all the financial planning, tax planning, retirement planning, and making sure that, hey, is the IPP a good tool for this particular client? So it's important that the financial advisor helps identify, hey, this makes sense or not for this individual, this corporation. And again, asset mix selection, portfolio RRSP, non-registered account, IPP, always have to look at that, and that's part of the advisor's role. The custodian is where the money is held. So they set up all the funding contracts, they administer all the investments, they provide all the investment reporting. And the new player on the block is the actuary. The actuary prepares all the calculations, tells you how much you can contribute. It's formally called an actual valuation report, which allows which recommends what contributions can be remitted to the IPP. All the paperwork is done by the actuary and third-party administrator, in this case, Ellement Consulting Group. And we assist with consulting too with the financial advisor about kind of the exit strategies when someone's ready to retire or sell their business. So some advantages with an IPP. I mentioned about not being afraid of, this is an individual plan as opposed to a group defined benefit pension plan. For individual defined benefit plans, we generally have to register with the provincial regulatory authority as well as Canada Revenue Agency. However, those residents in Manitoba and BC, we do not have to register with the provincial authority, and therefore we don't have any minimum funding required. So it's very good if you live in Manitoba, BC. Saskatchewan, Alberta have a little bit more rigid rules, but there's still ways around them as well. Contributions are higher than an RRSP, especially at age 40. That's kind of the crossover point. If we were to set up an IPP today, what about all the other years in the past that we didn't have an IPP? There's the actual ability to contribute based on past contributions if you had T4 in past years, and we'll go through an example of that. As I mentioned, if there were deficits or market corrections, 2008, 2009 is a common example I use, but even most notably last year, if we prepare a valuation report for the IPP and there's a deficit, that deficit can be funded. So you have more control over your financial future with the IPP. Huge advantage. RSP, you don't have any new contribution unless you go into the next year with your regular new contribution of $29,000, right? IPP, you have a little bit more control of your contribution. You don't have to make the contribution you don't want to, but you do have the advantage. And the IPP, very important, is separate and apart from the corporation. It's not form part of the corporate assets. It's actually what we call a T3 pension trust. So it's a separate trust from the T2 corporation. So that provides creditor protection. No, if you were ever sued, your business were ever sued for whatever reason, you cannot go after the IPP. So very important to have that distinction. There are flexible benefit options on retirement or termination. You can either pay from the plan, transfer to a life income fund, or purchase an insured annuity. I apologize for mentioning a couple of these terms. I have to. So those not familiar with the pension industry, again, consult with your financial advisor. We'll go through this a little bit further at the very end of the presentation about the exit strategies for an IPP. Contributions. When contributions are made from the company into the IPP pension trust, they do not attribute any Canada Pension Plan or employment insurance on them, so that's very good. Fees are tax deductible by the company, so you can arrange, if the advisor or financial institution provides, to have investment fees paid by the corporation or paid by the trust. You can have actuarial fees. The actuary has to get paid too. That could be paid directly from the corporation or from the fund assets. The choice is really the client's. And the IPP really is another tool in the tool chest, really, especially if you're a business owner. Definitely should consider this. Okay, what are the disadvantages? The big disadvantage is once you make the contribution or the company makes the contribution from the company to the IPP trust, those funds are what we called locked in. It's not like a regular savings account where you can just kind of move money back and forth. Once it goes there, it's generally locked in. There are ways to get at it down the road, like if you wind up the IPP program, we can do that. But this is really a pension trust fund and mentioned for pension retirement savings, right? So there's a few restrictions that the regulators impose on us, and one of them is the assets are locked in once they go in there. Another disadvantage is you require an actuary, another professional to sign off on eligible contributions. So there is an added expense there. We'll get into that very shortly. You should be doing this already, but everyone should have a financial planner or do some financial planning. With an IPP, it's just an added layer. You're dealing with a corporation as well as your individual savings, so there's some increased financial planning required. Not too bad, and those sophisticated financial advisors that do this for a living, or they can consult us as long as there's enough leeway in terms of years for when any event is going to happen. We can generally work with it. Large surpluses in the future. So I mentioned about what if the assets go down because of markets? Well, what if they really went up and you had very good returns? Large surpluses in the future could reduce future contributions. There's so much that we're allowed to carry in terms of surplus. This is a regulation requirement. Won't get too much into detail here. It's really a good problem to have, right? Your assets did very well, right? And might not be able to contribute as much in the future. But we always look at this every 3 to 4 years and reset the contribution schedule. So we monitor it very frequently. And the final thing is, again, mention this very at the end again for our exit strategies. When you're going from the larger IPP or registered pension plan vehicle to a smaller locked-in RRSP or locked-in retirement account, unfortunately, there are some regulations, really notably the Income Tax Act, that restricts how much money we can actually transfer from the larger IPP vehicle to the smaller locked-in RRSP. It's called a maximum transfer value. Won't get too much into detail, and I apologize for some of these terms, but with appropriate financial planning, this can be mitigated entirely. So it generally creeps up when a business owner sells their company suddenly and proper planning wasn't done in advance. So there's ways around that as well. Okay, so what are the costs? You have your normal investment management fees. That would be with your non-registered, registered accounts as well, similar with an IPP. If you have more assets under management, presumably you'll be able to get a fee break too on that. The new fees are really the actual administration fees, and I can only speak with what we charge here. Other firms will charge, setup fees, triennial fees, fees for phone calls, fees for winding up a plan. At this time, Element doesn't do any of that. We just charge really a retainer, an annual admin cost, and that'll include plan setup, regular maintenance. So if there's any compliance forms, amendments that need to be done, actual valuation reports that recommend what contributions should be made to the IPP, plan options, exit strategies, consultation with your financial advisor or legal counsel, and winding up the report. We don't charge any extra for that. We just charge a flat retainer, currently around $1,500 plus tax. I'm going to pass the mic briefly now to Lucas, who will go over a couple examples of just show you a little bit about what the numbers could look like. Again, these are very general, and everybody's circumstances will be different. And but yeah, I'll pass the mic to Lucas now.
Great, thanks, Scott. So this example here is meant to demonstrate the savings and financial advantage that an IPP offers for a member who is age 50 and who has 20 years of service and high earnings with their company that's going to sponsor or contribute to the pension plan. So the 20 years of earnings and service is going to equate to a monthly pension of about $5,400 a month, starting at age 65, or about $65,000 per year. Now, the pension doesn't have to commence at 65. You can commence it earlier or later, but we chose age 65 for this example. Now, that pension of $5,400 a month is going to establish an actuarial liability of about $712,000 immediately upon inception. Of that $712,000, $572,000 will need to be transferred from the member's RRSP into the plan. And the reason this transfer exists is the member has already taken a tax deduction by contributing to the RSP. So they're not going to allow the company to also contribute on this money and double dip on those earnings and the tax deduction. So we transfer in the RSP of $572,000. That leaves us with a deficit of approximately $140,000 in the pension plan. Now this amount can be contributed by the company and is tax deductible. And this amount, it does not have to be contributed immediately for Manitoba and BC plans. It can be contributed immediately. It can be contributed over a short number of years or amortized into the future. But this opportunity is created immediately upon inception. In addition, we get continued annual contributions above 18% into the future that provides an advantage over an RSP. So again, we get our $140,000 contribution opportunity immediately, plus increased contributions above the RSP limit into the future. So this slide here provides the contribution advantage for this example that you get in an IPP compared to an RSP. So we can see in the chart, we have the member's age projected into the future. In the second column, we can see the contribution percentages that you're allowed to contribute at in an RSP. And these are in addition to the $140,000 that was created upon plan inception. So you can see at age 50, we can contribute 21.9% of earnings, and this grades up to 29.1 at age 65. And all these percentages are in excess of the 18% allowed in an RSP. So for a member that earns, again, approximately $160,000 and increasing into the future, in the third column, we can see the expected contribution opportunity each year for the new pension accruals that happen into the future. And then finally, in the fourth column on the right, we can see this is the advantage over an RSP. So you get that $140,000 right up front when you start the plan, plus these contribution advantages into the future. Plus, if there's ever a deficit in the plan due to a market correction, you can top those up. And one note, actuaries are required to use prescribed assumptions by CRA. So your numbers could look little higher, a little lower than this, but the same idea holds, is that your contribution opportunity in an IPP is greater than 18% once you turn about age 40. So here we have another example. It's the same concept, except this time the member is age 60. So we have the same 20 years of service and high earnings. We're going to establish that same monthly pension of $5,400 and the same RSP transfer is required of $572. However, as the member is a little older, we've established a larger actuarial liability equal to $859,000, and this creates an immediate funding opportunity of $287,000 that is again contributed by the company and tax deductible and can be contributed immediately or amortized over a number of years. And then finally, again, we can see as the member ages, the contribution percentage increases at age 60, 26.5, and again, grading up to 29.1 at age 65. And these contribution opportunities or percentages are greater than 18% that's allowed in an RSP, because these contribution percentages are the actuarial present value of providing that future pension. And the cost of providing that future pension is higher than the 18% that's allowed in an RSP. So that's where we're getting our gains here. Great, and Scott, I will pass it back to you to discuss the options about how do you get your money out.
So thank you, Lucas. After the presentation, if it makes sense for you, we can always do a personalized quote. So the first step in really does it make sense to me? We get a quote, right? We see what our particular numbers, how many years of past service can we buy back? Am I at the right age? Am I, cash from my company? If that all makes sense, then we establish an IPP. Okay. After that, that's kind of the first kind of major hurdle or stage. Second stage would be kind of your maintenance stage. You're contributing, your active employment, active with your business, and regular maintenance. Regular valuation reports where we say, okay, we're tweaking the contribution, we had a deficit or market correction or a surplus, we can contribute this amount. Kind of the boring part is stage 2, if you will, the kind of the maintenance, the active part. Then there's stage 3. Well, how do I get my money out, right? This is a retirement plan. What are my exit strategies? There are 3 exit strategies. Options A, B, and C. Option A would be that red column where it says monthly pension. Option B would be that blue column where it says wind up plan. And option C would be purchase annuity, that green column. So each column will have kind of pros and cons and will dictate whether you do one avenue or other. Sometimes we're forced to do one avenue because of certain circumstances, and I'll explain a little bit of that when we go through the details here. So option A, around 15% of our clients end up choosing. This would be to maintain the IPP structure and draw monthly pension from the pension plan itself. So company is still around, has to sponsor the plan for future contributions. It allows the opportunity for intergenerational planning opportunities. So if you have children in the business, they could be added right away to the IPP or down the road, and we can just tax defer that IPP asset to the next generation. That differs from an RRSP where, I have an RRSP, I pass on, it goes to my wife, and after my wife passes, then it goes taxable to the estate. No additional opportunity to tax for that asset. With an IPP, you can do that with some proper financial planning, and if the circumstances make sense for you. We see this a lot with small businesses with family members involved. This would be a good option. Because we wouldn't have to deal with any maximum transfer values, as I spoke earlier about, larger IPP conversion to a smaller locked-in retirement account conversion. There are potential tax consequences if proper planning is not done, so we don't have to worry about that with option A. Investment and demographic risks remain with the company, however, under the IPP, which may not be a big deal. Generally the business owner is the employer and the employee. Well, we know investments, you're managing your risk anyway with the markets, with the investments. When we talk about demographic risk, we talk about longevity. If you outlive your money, right? So if one lives well into the future, into their hundreds, right? Then, well, we need to make sure that money is there to be sufficient to provide that retirement income well into the future. With this option A, we always need what we call a genuine company to continue to quote unquote sponsor the program, one that had created service, one in which you had earned T4 employment income throughout the years. We can't just transfer the sponsorship of this program to a company that had nothing to do with it. For instance, if you, we encountered this a lot with small business owners or with legal professionals that incorporate where they either dissolve or sell their business. So they do a share sale, for instance. Well, if you're doing that, you've transferred ownership of that new company to the new purchaser, and generally they don't want to sponsor a program that had nothing to do with them, right? So we encounter a lot of situations where that, and that's why only around 15% of people end up doing this option A, but it is probably the best option to do if circumstances can be worked into the equation. Another important point to mention, Lucas mentioned actuarial assumptions, and I don't want to scare everybody away when we talk about actuarial assumptions, but there's certain assumptions that we are forced to use. This is an Income Tax Act requirement. For instance, we assume that the plan assets will grow at 7.5% per year, where in reality they may grow a lot less, especially now in a low interest rate environment. Especially when you retire, we still have to use the 7.5, right? But when you retire and become inactive, we're allowed to change that 7.5% assumption asset rate of return to something more reasonable, like a 4 or 5%, right? We don't expect our assets to turn more than 4 or 5%. And when we do that, we actually increase our liability compared to our assets, which enables the IPP plan sponsor to potentially fund a greater deficit. It's considered more of a funding opportunity rather than a funding obligation. So some of our clients in which this option A makes sense for them, they're able to put well into the 6 figures, sometimes 7 figures, depending on the case. The second option, option B, is by far the most popular option, simply because option A doesn't work for that circumstances. So about 80 to 85% of our clients end up doing this option B. So what is option B? Well, this strategy is to wind up the IPP and move from the larger registered pension plan IPP vehicle to the smaller locked-in retirement account or directly to a life income fund vehicle. I mentioned this at least 2 times. We have maximum transfer rules that we have to adhere to. This is an income tax requirement. Again, with proper financial planning, we can mitigate this risk, but as long as we know well in advance what that event date is, we may just tell the client not to contribute anymore to the IPP in the final few years of their active career. Similar to the option A, investment and demographic risks remain with the member in this case. Option A had a company. This one is the member. You still have to make sure that you earn a great enough return and you don't outlive your money, right? So that risk is still on the member in this case. We say the company in option A, but really the company ends up being the member themselves too. The final exit strategy, option C, is by far the least popular option. I've only had less than 10 individuals out of the hundreds that we've done choose option C. This would be to wind up the IPP and move your assets to a licensed insurance carrier in Canada, Sun Life, Industrial Alliance, Canada Life. And that could be a good strategy depending on the circumstances. With a low interest rate environment right now, the premiums that the insurance companies are quoting are extremely high. So why would you ever do this option C? You're afraid that the market, you don't want to deal with any more investment risk, or I don't want to outlive money. I have a lot of outside money over here. I want to kind of immunize this part of my portfolio. You can do this. You'll pay a premium to offload that risk, but if you do it, you can get a tax deduction for your corporation. It's an additional contribution requirement that the insurance carrier is requiring to take on that investment and demographic risk. But in certain cases, people would be okay with that if they have other risks outside, maybe other business ventures or non-registered assets that they're having to manage, and maybe they want to immunize this part of their portfolio. So it is a viable option and can be considered. There is no cost to get an insurance quote, and your financial advisor can certainly help you with that. So just to close and recap, what would an IPP be good for? What type of candidate? If you're incorporated, if you're an owner of your business. We have a lot of legal professionals that have been able to incorporate since 2004, a lot of dentists, doctors, but really small business owners that tend to be the good chunk of our clientele. And if you have high employment income, I'm talking about T4 slips with 160,000 or more, could be a little bit less and could be growing. It still may be a consideration, but generally we want 160,000 or more. You do have the opportunity to contribute for past years in which you didn't have the IPP, so that's great too. And Lucas went through a couple examples. When you hit age 40, the contributions are greater than 18% and greater than RRSPs. So RRSPs on steroids, a few special rules with IPPs, but can certainly be a great tool in your tool chest. There are a lot of retirement options to maximize tax efficiency. Went through a few of them. Again, financial planning required to deal with that. But if it's done properly, we can mitigate all those risks, and it could be great solution. With a option A, small business planning, you could do intergenerational transfers to the next, to your children down the road. We do have certain cases where it just works beautifully. They're able to defer any crystallization of tax, and then they're helping retirement income for their children. So that ends up being a very, very good planning tool. And in the end, if this makes sense for you, please contact your financial advisor or Ellement Consulting Group, and we can do a kind of personalized quote for you. There's no obligation. If the numbers make sense, great. If the situation makes sense, maybe you want to take the next steps. If not, that's okay too, but it doesn't hurt to ask. All right, thank you.
Wonderful. If you just want to close your screen, stop sharing the screen, and there we go. Back again. Thanks, gentlemen. I appreciate the talk. Very good presentation. Just a couple questions, and I have some ones that are maybe that you're not used to hearing, but please let me know, because I took some notes during your presentation. But I'm curious. So do you provide financial services advice, when you're going through the process? Do you provide the overall financial plan when you're starting the IPP process when you're consulting with a client?
So because we only know one part of the the whole portfolio or the individual or family's needs, we'll kind of we'll be part of that process. It's really the financial consultant advisor that really brings us in as one of those tools to help. Hey, does this make sense based on this information? Because if we don't have that all that information, we can't really give that advice. But if based on what you tell us, we can certainly be part of the solution.
Okay, so you work with the client's financial advisor as part of the financial plan. So is that part of your setup cost fee? That's covered. All that consulting advice is covered. There's no additional cost to the client in that process.
Correct. Okay. So no, we don't charge setup. Other firms may do that. I can tell you what we do. We don't charge for that setup. If we help with the dealing with financial advisors, who, part of their learning process, and once they do know about the IPP, we don't have to keep re-educating those different advisors, right? They know it already, and it's more educating the client on their circumstances.
Okay, so can an IPP be set up if a client is over 65?
Yes, it can. As long as they're not over 71.
Over
so 71. That's big. We send our target market to that 40 to 70. You could do it when you're 35. As long as they're not 71, the year in which they're 71, we can certainly set up. In fact, we've done cases where an individual's been 71, set up the IPP and retired them right away.
Okay. And also, I was curious, what happens when if you have a husband and wife in the IPP, what happens in case of a divorce? I'm sure you've had this experience many times, but I'm sure.
Not as many as you would think, but it does happen. We don't file so I'll speak with Manitoba because a lot of our clients are in Manitoba. But no matter which jurisdiction, even though we don't file with the Manitoba provincial regulator here, we still have to adhere to certain sections of the Pension Benefit Act. And one of them would be family property division. So we would have to divide the assets or provide the calculations and then say, hey, I don't want to divide my pension. I'll take the house. You keep your pension, right? We do have to go through that process, unfortunately.
Okay, so there's a process there. But it's the division is based on the date of separation legally?
Yeah, period of marriage and cohabitation, right? So if you had an IPP and then you got married later, it's kind of that window where you were cohabitating.
Okay. And so who is this not for? Like, who does this strategy not work for at all? Who is not a client for you guys?
So if they're not a business owner, right, or key executive, because we do have key executives that do participate. So say you have
larger corporations.
Not necessarily. Sometimes they're just high earners. They don't own any shares or very little shares of the business, but the business owner wants to keep that relationship or keep that key employee tied into the business. They'll set up an IPP and we can do a few things there. It's actually happening a little bit more recently. It's just another way to tie in a key person without giving them shares too, right?
All right. So here's an idea. I just had a client who owned a $100 million business and he sold it to a publicly traded TSX company. So he's obviously got a massive capital gain on his hands. He has RSPs, a lot of them. But he's an insider for the new public company. Would this individual be a prime candidate for one of those key executive IPPs?
He could be. It would be the powers that be now that would look at his compensation package. Right. So if someone's getting paid, $300,000, just throwing a number, $300,000, maybe they don't want to get paid all on their T4. Maybe they want, $250,000 on their T4. And maybe they want to defer $50,000 for an IPP contribution.
I see.
The company would be indifferent because they're still paying $300,000 out.
Right.
So you can be seeing that a little bit too.
I see. Okay, understand. Well, wonderful presentation, gentlemen. I really appreciate it. To everyone listening, thank you for tuning in. And certainly, if you have any further questions, you can contact myself, or you can reach out to Ellement Consulting Group directly. Scott and Lucas, thank you both so much for your time, your expertise, and the presentation was absolutely excellent. So thanks very much, and we'll sign off for now.
All right. Thank you.
Thanks.
Bye-bye.